Hi everyone, welcome again to RHB Assets Management Podcast Series. I'm Fauzi, Chief Investment Officer, Equity Malaysia. The high COVID-19 cases which has led to the re-implementations of the lockdown from early June and the uncertainty in the domestic politics have dampened market sentiment. The FBMKLCI Index has declined by 5.1% since June and 7.6% year to date. The lockdown has dented the prospect of a strong recovery in the economy in 2021. Although Malaysia recorded second quarter 2021 GDP growth of 16.1%, which was higher than the median estimates of 14.1%, Bank Negara Malaysia has revised down GDP projections for 2021 to 3 to 4% from 6 to 7.5%. This projection is in line with many economies who have revised down the GDP projections to an average of 4% when the government started to re-implement the full lockdown in early June. The government estimated economic losses of 1.1 billion daily on Malaysia's GDP throughout the current movement control order. Hence, the domestic economy would be impacted if the full lockdown stays for a longer period. Bank Negara Malaysia expect a much weaker GDP growth in third quarter, mainly due to the reimpositions of nationwide containment measures. The lockdown measures have impacted the factory output significantly. The Manufacturing Purchasing Managers Index for July fell 19.8% from a year ago to 40.1 after a decline by 21.8% to 39.9 in June. The industrial production also dropped in June by registering only 1.4% growth from a year ago. However, the impact of the lockdown on the PMI this time was not as significant as that in April 2020, as certain essential sectors are allowed to operate with strict operating procedures. The government is aware that the economy cannot be closed for a long period of time and has been accelerating the vaccination program. The lockdown measures would have a negative impact not only on the economy but also social implications. Most of the countries, especially in US and Europe, which have achieved at least 50% of its population vaccinated, have opened up their economies. Hence, the government is expected to ease gradually the lockdown measures as the vaccination rates goes higher. As of 16 August 2021, 52.3% of total populations have received one dose and 32.9% of total population have been fully vaccinated. The successful implementations of the vaccination program and the reopening of the economy are important factors for better index performance in the future. The government announced recently several easing restrictions for individuals who have been fully vaccinated and the opening of non-essential sectors, which is positive for the economy. Additionally, the government also announced that the new requirement for transitioning from phase 1 to phase 2, which include number 1, 50% vaccination rate of the adult populations, number 2, daily hospital admissions of symptomatic cases must fall below 6.1 per 100,000 people, and number 3, ICU bed utilizations must be moderate. Historically, the index would normally follow the directions of the corporate earnings growth. Malaysian corporate earnings growth have peaked at the end of the first quarter of 2021 and has come down since then. Despite the full lockdown, the corporate earnings growth estimate have been very resilient and only came down by 3.8% since early June. This is positive to the market, and we believe that we should see another round of earnings upgrade once more sectors in the economy are open. We also believe that most of the negative news have been factored by the equity market. The index is cheap now. The FBMKLCI Index is trading at prospective price-earnings ratio valuation close to its 10-year low. To conclude, we expect the performance of the index to be volatile in the short term due to the concerns over the fast spread of the new COVID-19 variants and its impact on the economy, the uncertainties in domestic politics, the high US inflation, and the potential slowdown in China economy. Persistent high US inflation rate would force US Federal Reserve to hike interest rates sooner than expected and reduce its bond buying program. This would dampen the global equity market sentiment, which has been rallying on the back of loose monetary policy and ample liquidity. In addition, the surprise move by China's central bank recently to cut the reserve requirement ratio may also suggest the slowdown is beginning to have a negative impact on China's economy. This would have a negative impact on the global reflation trade theme, and US dollar may appreciate further. Thank you.